Welcome. In this video, we will analyze whether Zbcn coin or Hbar makes 100x before. We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
First of all, when we talk about the existence of such an uptrend structure, one of the most striking elements in terms of technical analysis is the reaction the price gives when it approaches or touches this trend line. The ascending trend line is actually a visual reflection of the market's overall psychology and the participant's perspective. Because if the price keeps making higher lows, this shows that buyers are protecting the market, that each drop finds support at a higher level, and that selling pressure remains limited. Within such a structure, when the price approaches the trend line, it opens a new door of opportunity for many investors. This line represents the area where buyers are expected to step in again and sellers begin to lose strength. That's why when the price comes back to this trend line, the general expectation in the market is for a bounce, an upward reaction. This bounce expectation is not based only on technical indicators. It is also directly related to the psychological side of the market. Many investors watch this trend line, see it as a potential buying opportunity, and place their orders around these levels. As a result, when the price approaches, the order density increases, buyers step in, and the market shows upward movement again. That's why the expression bounce off the trend line is actually a result of investor behavior. Every pattern we see in technical analysis is rooted in human psychology. A bounce from the ascending trend is one of the clearest reflections of this behavior. Another important point is that this bounce is not a one-time event. As long as the ascending trend line exists, it is expected that buyers will step in again and again every time the price touches this line. This increases the reliability of the trend. Especially if the market has been respecting this trend line for a long time, its importance grows even further in the eyes of investors. Because if the price keeps bouncing and moving upward from the same line each time, it is no longer considered a coincidence, but rather accepted as a strong support zone. At this stage, investors start to buy with more confidence, which further increases the probability of a bounce. The strength of a bounce also lies in its signal of trend continuation. In technical analysis, there's a saying, "The trend is our friend." As long as the trend is intact, it is expected to continue in the same direction. A bounce from the line in an uptrend shows that the trend is continuing in a healthy manner. This is a positive signal both for short-term traders and long-term strategists, because it confirms that the upward structure of the market remains unbroken and that strong bullish momentum is still in play. Therefore, a bounce from the uptrend is not just a short-term move, but also an indication that the larger upward story is continuing. Of course, there are factors that can strengthen the effect of this bounce. For example, if when the price approaches the trend line, there's also a Fibonacci support, a horizontal support zone, or an important moving average at the same level, then the likelihood of a bounce becomes even stronger. In technical analysis, the convergence of different indicators at the same point increases investor confidence and raises the probability of the price reversing upward. So even though the trend line alone is already a powerful tool, when supported by other indicators, it becomes an even stronger buy signal. In addition, a bounce from the trend line is not only technically significant, but also important in terms of risk management for investors, because those who buy from the ascending trend line can place their stop-loss orders just below it. This creates a low-risk, high-reward trade setup. The potential loss is limited, but the potential profit is much greater. That's why even professional investors and large funds often closely follow prices as they approach trend lines and are not hesitant to take positions there. Moreover, a bounce from the trend line doesn't just affect how investors view the market, but also shapes the market's potential future moves. Because after such a bounce, the price usually tends to form a new high. Each bounce followed by higher levels shows that the trend is getting even stronger. Therefore, these bounces are not just temporary reactions, but building blocks of the long-term uptrend. From a psychological perspective, a bounce from the trend line reinforces investors' confidence. As they see the price rise after every touch, they start to believe more in this trend line and open more positions. This creates a herd psychology that further supports the price's upward movement. In other words, the bounce is not just a technical event, but also a reflection of trust and collective behavior. In conclusion, if such an ascending trend line exists and the price approaches it again, The most natural expectation is for the price to bounce upward. This bounce shows that the trend is continuing healthily and that buyers remain strongly present in the market. Reactions from the trend line are one of the most important signals determining the market's direction in the long term. As long as the trend line remains a strong support area in the eyes of investors, the price will keep bouncing upward with every touch. Thus, the uptrend continues intact, offering safe and profitable opportunities for investors. But we can't base our analysis solely on trends, so let's take a look at other metrics as well. Stay tuned.
When analyzing the chart of a financial asset, the formation of higher highs and higher lows is considered one of the most fundamental and strongest indicators of a bullish trend in technical analysis. The structure of higher highs and higher lows directly reflects market psychology and investor behavior. When we talk about higher lows, it means that each pullback ends at a higher level than the previous one, showing that buyers step in during every decline to support the price at higher levels. This indicates that the buying tendency of market participants continues, and that selling pressure has not yet reached a level strong enough to stop the uptrend. Similarly, higher highs mean that each new peak is higher than the previous one, signaling that upward momentum is sustained and buyers maintain dominance in the market. When these two factors come together, the mechanism of an uptrend is complete. Lows act as continuous support for the rise, while highs confirm the upward movement of the price. This structure is extremely valuable for investors both visually and strategically. The formation of higher highs and higher lows signals trend continuation and shows investors the likelihood that the price will move upward for a certain period of time. One of the most reliable ways to determine the direction of a trend in technical analysis is by following such structures. If the price continues to make higher lows and higher highs, this confirms that the trend is intact and buyers remain in control. As a result, investors can continue to take positions in line with the trend, manage their risks more effectively, and shape their long-term strategies according to the ongoing trend. The trend formed by higher highs and higher lows also demonstrates market momentum. The desire for the price to move upward is not limited to short-term fluctuations. With each new low and high, this tendency strengthens. In particular, buyers supporting the price at higher levels during each pullback shows increasing confidence and bullish momentum in the market. At this point, investors receive psychological confirmation that the trend will continue, which leads to additional buy orders being placed. Therefore, the existence of higher highs and higher lows is not only a technical indicator, but also a direct reflection of investor behavior and market psychology. One of the most critical factors in confirming trend continuation is whether the price deviates from this structure. If the price does not fall below higher lows and continues to break above higher highs, the trend is confirmed. However, breaking below the lows or failing to reach new highs indicates weakening of the trend and fading momentum. For this reason, investors constantly monitor the structure of higher highs and higher lows. As long as this structure is preserved, they continue to maintain positions in the direction of the trend. It is important to note that trends are often tested by short-term pullbacks. These natural fluctuations may cause temporary volatility, but they do not change the overall direction of the trend. The continuation of higher highs and higher lows is also crucial for long-term investors. This structure serves as guidance in determining the overall direction of the market and potential target price levels. Each new low and high shows investors the upward potential of the price and confirms that the trend remains intact. When combined with major moving averages, Fibonacci levels, and other technical indicators, higher highs and higher lows provide investors with a strong foundation for building analysis and strategy. As long as this structure demonstrates the continuous dominance of buyers in the market, it gives investors confidence and signals that the trend is likely to persist for an extended period of time. From a psychological perspective, higher highs and higher lows build investor confidence. As investors see each pullback ending above the previous one, they become more convinced that the trend will continue and open positions accordingly. This results in increased buying activity in the market, contributing to the reinforcement of the trend. In other words, higher highs and higher lows are not only a technical indicator, but also a significant reflection of investor behavior and market psychology. When evaluating the potential returns of Zbcn and Hbar, the concept of market capitalization or market cap is a critical parameter for understanding how much an asset can grow and its potential for appreciation in the crypto market. Market cap is simply calculated by multiplying the total circulating supply of a coin by its price, and it shows investors the overall value of that asset. Hbar's current market cap is at an enormous level of $10.67 billion. This makes the likelihood of Hbar achieving a 100x increase extremely limited, because if such a rise were to occur, Hbar's total market cap would reach an unbelievable
unbelievably massive level, something nearly impossible to sustain in terms of market size and liquidity. In other words, a 100x rise from Hbar's current position would surpass the logical boundaries of market capacity, making it practically impossible from an investment standpoint. On the other hand, Zbcn's current market cap stands at around $464 million. Compared to Hbar, this is much smaller and therefore provides a more flexible range for potential growth. A smaller market cap makes it more realistic for the price to multiply in the same proportion. For Zbcn, a 100x increase is a far more realistic scenario than it is for a coin with a massive market cap like Hbar. With a smaller market cap, the multiplication of price is much more achievable from the perspective of capital inflow into the market. This explains why investors seeking high returns often prefer smaller market cap projects. In addition, Zbcn's already low market cap can also be seen as a potential opportunity in the eyes of investors. A small market cap allows even limited capital to have a meaningful impact on price. This shows that Zbcn offers suitable conditions for exponential gains. Hbar, on the other hand, with its massive market cap, is already trading in a more mature market, making a 100x increase nearly unattainable under current conditions of capital and liquidity. Moreover, Zbcn's lower market cap also changes the risk-reward balance for investors. Small market cap projects inherently carry higher volatility and speculation potential. However, this also brings higher profit opportunities. In other words, when an investor enters a project like Zbcn, the potential for the price to increase significantly and generate outsized returns is much greater compared to Hbar. The logic here is simple. Starting from a low market value, price multiplication allows investors' profits to grow rapidly. In Hbar's case, its high market cap makes such dramatic price increases much harder, pushing a 100x goal into nearly unreachable territory. From a psychological perspective as well, Zbcn stands out as a more attractive opportunity. When investors see the possibility of fast and substantial gains in a small market cap asset, they tend to allocate their capital more aggressively. This increases buying pressure in the market and allows the price to rise more quickly. With Hbar, however, its large market cap and mature market structure make it difficult for investors to buy in with the same aggressive mindset, making such astronomical gains harder to achieve. In conclusion, Zbcn's chances of achieving a 100x increase are much higher than Hbar's simply because its smaller market cap provides a more suitable environment for exponential growth. Hbar's massive market cap makes such astronomical growth practically impossible. For Zbcn, the amount of capital required for significant price appreciation is much more attainable, making it more appealing to investors. From the perspective of a 100x increase, Zbcn is a far more likely and logical choice. Considering the opportunities created by a small market cap, market psychology, liquidity, and price flexibility, it is technically and logically accurate to say that Zbcn has a much higher chance of reaching 100x before Hbar. Investors looking for high return potential may therefore prioritize small market cap projects like Zbcn, which still have room for expansion, while Hbar's massive market cap limits its ability to provide similar gains in the short term. Zbcn's potential is not limited to market cap alone. The project's development roadmap, partnerships, and user base growth also support the likelihood of price multiplication. This gives investors tangible and realistic growth scenarios in addition to market cap. Hbar's enormous market cap, however, serves as a limiting factor for such exponential growth scenarios. From an investment perspective, this makes it reasonable and far more likely for Zbcn to reach 100x well before Hbar.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments. Analyze the risks correctly and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.